the statement from the fund focused on fiscal consolidation. We've heard that phrase over and over again over the last 3 to 5 years, but Kenya's finance ministry has been promising fiscal consolidation for years and it's failed to do so. Do these latest promises of fiscal consolidation have any credibility?
Thanks, Rama, for having me on the show. Speaking of fiscal consolidation in the current fiscal year and also in the next one, against the context of COVID-19, I think that even the IMF have sort of closed their eyes on that and somehow said that fiscal consolidation may not be achievable in the current financial year and in the next one. But having said that and looking at the Kenyan authorities, so to speak, we've seen that in previous financial years, even before the budget is passed, you find that there are usually some revisions. Be it through the budget policy statement, you find that the figure is lower than what will be approved with the budget. So you find that it's usually a moving target, that fiscal deficit in any given financial year. So even in the current context, in regards to credibility by the authorities, I don't think that that is also in the cards. You hear the phrase that a leopard does not change its spots, and that could be aptly referring to National Treasury. Right now, in the current financial year, amidst, even against the backdrop of COVID-19, on the budget policy statement, Treasury is quite clear that they are not pursuing an increase in public expenditure. But right now, we are on the cracks of supplementary budget, one estimates, which is skewed towards an increase of $750 million. So to me, it's just telling us that there's still not that credibility by the Treasury officials, at least to see some form of fiscal consolidation to be in place in the country.
Indeed. So the statement from the fund also has some other interesting elements in it. It says that the program, the 38-month program, Kenya is agreeing to under this in exchange for this $2.4 billion loan. It says it will focus on raising tax revenue. But in December, we removed pandemic relief measures. Income tax rates on personal income, corporate income went back up to 30% on the top rate. The 200 basis point cut in VAT, that was removed. We introduced at least 2 new taxes, a minimum tax and a digital services tax with effect from the 1st of January. We've removed pandemic relief. We've added more new taxes. Is there any more room to raise taxes further?
Yes, we are coming at a point whereby some of the tax reversals that were there in the initial days of COVID-19 were reversed at the front end of this year. So we don't see that there'll be much wiggle room in terms of having some more additional tax revenue streams per se. And just against the backdrop that next year is a campaign year, is an election year, that issue about bringing on board some new tax revenues will become a hot potato issue. Having said that, and if I take you back to last year's when you had the tax laws amendment, the first tax laws amendment act, whereby that uplifting of some of the tax incentives that were then in the country, I think, in my view, that was the route that we saw in terms of having some tax revenues being put in place. But having said that, I don't think that there's any more measures that will be put in place in terms of new revenue streams, other than now putting in place some of these controls to reduce slippages in tax and also the tax administration. So that's where the emphasis will be.
Right.
But to be sure, we are saying that in the next financial year, ordinary tax revenue has been jacked up by $2 billion, which is just telling us that it's primarily hinged on our growth recovery, with Treasury now estimating a 7% jump in the growth in the current calendar year.
It's a very optimistic outlook. One last question for you, Churchill. So without any aggressive debt restructuring or reprofiling, to use a term that the authorities prefer to use here, Kenya can't meaningfully reduce its debt service costs, can it? Because we're spending something in the order of $8 to $9 billion every year just on domestic and foreign debt service.
Yes, and in fact, you find that there's a skew that there's been not getting into the commercial financing, which we saw it play out in the last financial year, but there's been a bias towards the domestic front. But having said that, the costs, if you look at it, is in the order of 8% going up, is still elevated on the domestic front. Looking at avenues of restructuring, I think it's the Treasury or Kenya is in a tight spot. But having said that, at least there's been some positive developments just looking at the budget policy statement, whereby there's an expected refinancing of some of the external debt. In the current financial year, we're seeing something in the order of $2.2 billion. In the next financial year, $3.5 billion. So to us, it could be now those commercial financing, be it Eurobond or the syndicated bonds, and just taking advantage of what's happening in the current global arena, whereby there's that outsized liquidity from the developed market, there's hunger of yield by some of the investors, and also the yields of even in the Eurobond have somehow reduced, tanked compared to where they were pre-COVID-19. So all these three factors are coalescing to at least make the environment more favorable to a refinancing, but we'll likely see how that will be executed in the next 4 months towards the end of this financial year.
Indeed, a Eurobond, of course, is certainly on the cards. We'll leave it there for the time being. Churchill Ogutu, head of research at Genghis Capital.